In this lecture, we're going to talk about liabilities, both short and long-term liabilities. So let's go ahead and jump in. The example here is Verizon. Now, Verizon has liabilities of $286 billion, and that includes long-term debt of $233 billion. Its debt represents 75% of their assets, so that suggests they are heavily levered. That means lots of debt. And so that's how they've chosen to finance their operation. The nature of liabilities is that it arises from past transactions or events that require settlement at a future date. So the example just on the last slide here of Verizon suggests they have received money, cash typically, and now that's the past transaction that they're now required to pay back. And so they have these in common. I often think of a liability as a future probable sacrifice. They're going to have to give up something there. So businesses typically have two basic sources of financing. Sometimes we call that capital structure, and that's liabilities and equity. So either they're getting loans from suppliers and banks and bondholders, or they're getting equity from owners, where typically they are purchasing stock. And so we note the differences here. Liabilities eventually mature, and they need to be paid as they come due. And the providers of these monies are called creditors rather than owners. The owners is in the owner's equity or shareholder's equity. And this can be separated into the original investment or the contributed stock or retained earnings. Those earnings have been retained by the company, and it does not ever mature. The claims of creditors, so those are the ones that provided debt to us, have legal priority over the claims of owners. So, in general, if a business ceases operations or goes bankrupt and liquidates, the creditors must be paid in full before any distributions can be made to owners. Okay, so we recognize that that they will get paid first, so they have less risk than do the owners. Now, the creditors have certain claims and relative order. So it would be who has primary or first rights, who has secondary rights, so who will get paid first. There are also some liabilities that are not secured by specific assets, and these are general credit obligations. So they may not have a specific note with claims to cash. And so that would be an example of a general credit obligation of the company. Now, there's also liabilities that bear interest. So many long-term liabilities, like long-term debt, a loan from a bank, and even some short-term ones require the borrower to pay interest. And so we're going to recognize interest and accrue interest as of the balance sheet date. So the borrower has an obligation to pay this interest in future periods, and it needs to be included and disclosed in the financial statements, the footnote. Now, many liabilities are for a definite dollar amount. They don't require an estimate. This is clearly stated of what is owed, how much is owed, very specifically. But there are also some that are estimated, where the precise amount of liability, we know it exists, but we don't know the precise dollar amount. So let's say, for example, I buy a car and they give me a warranty for 5 years or 100,000 miles or 30,000 miles. Well, it's not exactly clear, especially when the car is sold, specifically how much work is going to be required to maintain that warranty. And so it has to be estimated. And so that's an example of an estimated liability. So as we go further and define liabilities, we separate these liabilities into current or short-term and long-term liabilities. So the current ones are those expected to be paid within 1 year or within the operating cycle, whichever is longer. So those would be current, and it's going to be paid from current assets like cash typically, or by rendering services. So if you had unearned revenue, you committed, you had received cash for football games, and the football games haven't happened yet, but the football games are expected to happen within the next year. That would be through the rendering of services, or in this case, providing the football game. Now, all liabilities not meeting the criteria of current are going to be considered long-term. And so those would be typically longer than 1 year. And we have some indicators of this liquidity. What we're trying to determine is the ability to pay those current liabilities as they come due. And since they're going to be paid out of current assets, if we go back one slide here, we're going to see these are going to be paid from current assets. And so we're going to see, hey, what kind of cushion do we have? And so we're going to use our working capital ratio, which is the excess of current assets over current liabilities, or we're going to use a current ratio, which is similar, but now current assets divided by current liabilities. So we would hope and expect that working capital would be positive, and we would expect that this would be greater than 1. But, again, it's you feel some cushion there if it is greater than 1, but it doesn't mean it always exists. And so that's something we monitor and track. The most common examples of current liabilities are accounts payable. Accounts payable are typically owed to suppliers. Short-term notes payable, so we have a loan, but it's for a very short period of time, less than a year. Current portion of a long-term debt, so we have sometimes consistent payments to be made over time. And so any that's going to be paid over the next year would be included as an example of a current liability, even though the long-term debt might go much, much longer. Next, we have accrued liabilities, and accrued liabilities would include interest payable. So this is the interest that we owe and will pay. Income taxes payable, payroll liabilities like salaries payable, or unearned revenue, or other examples there. And we go through kind of one by one. So accounts payable here are short-term obligations to suppliers and might be liabilities for any other goods and services provided as well. So not just purchases of merchandise, but also services. Notes payable are typically issued by a bank, and that might give rise to notes payable might be because we purchased real estate, and now we've signed that we will pay over time. We might have purchased some merchandise or some equipment, or it might be a substitution of a note. So if we can't pay the accounts payable or decide not to pay for the accounts payable, we might sign a more formal note where we have formally committed to pay. Notes payable usually requires the borrower to pay interest. That's they aren't able to pay yet, so they must pay some interest. An example of a note payable might look like this. So on November 1st, Porter Company borrows $10,000 from its bank for a period of 6 months at an annual interest rate of 6%. And so you can see this formally written here. 6 months later, it was a 6-month note. 6 months later, we pay the $10,000 plus the interest. So 6% is the annual rate, and typically given as an annual rate, you can see it says 6% per annum here. And so we went 6 months, so half of that year, 6/12, and then the principal was $10,000. And so this shows how much we need to pay. So the journal entries would look like this. The journal entry would be when we got or signed the note, debit cash, credit notes payable for $10,000. And that's for November 1st. Now, no liability for the interest is noted when the note is issued or not booked. But at the date that $10,000 is borrowed, the borrower has a liability only for the principal amount of the loan. Okay, so that's what we're recording. But at December 31st, 2 months interest expense has accrued. And so we need to recognize that. So on December 31st, we need to record that 2 months interest expense has accrued. And so we're going to take the $10,000 times the 6% annual interest times the 2/12 gives us $100. We're going to debit interest expense and credit interest payable. Why credit interest payable? We haven't paid it yet. We won't pay till the end of the 6 months. So you can see what that looks like. Now, fast forward to May. So the loan is due. So we're going to pay back the $10,000 and get rid of that. We have the interest payable for the first 2 months. And then we have interest expense for the last 4 months. So you can see that computation here. And so we're going to pay $10,300 to take care of that note. We also have current portions of long-term debt. I often use the example in my class of a mortgage loan. Mortgage is a monthly payment, and you're going to say, hey, any principal amount due within 1 year is regarded as a current liability. So anything due the next 12 payments are going to be classified as a current liability, and the rest of the obligation, the rest of the loan, will be classified as a long-term liability. As far as accrued liabilities go, these are ones that rise from the recognition of expenses for which payment will be made in a future period, or sometimes we call these accrued expenses. Now, these are those adjusting journal entries we've been working on, and we just provided an example of interest payable, but we might also have income taxes payable. So we owe the money, we haven't yet paid it out as cash, we need to recognize the income tax expense. But since we haven't paid cash yet, we're going to recognize a payable. Or salaries payable or payroll liabilities, I would say, are synonymous terms. So the employees have worked for us. We have not yet paid cash. And so we need to record a payroll liability. So as far as payroll liabilities, those include not only the payroll itself, but also all of the payroll taxes, such as Social Security, Medicare taxes, any unemployment taxes we're subject to, and any state employment taxes. And you'll see this will vary from state to state. And so you can see what those look like. We also have workers' compensation insurance. And this is a state mandated program that provides insurance to employees against job-related injury. And so if injuries occur, the company have saved up money essentially, or they've paid for the insurance premium. And, depending on how many accidents there's been in the past, the premium or the amount of the insurance cost will change. Other payroll related expenses. Well, we might agree to pay for portions of health insurance, life insurance, any pension or 401k plans that we as an employer make. And so those would be payroll related costs. And then we need to also recognize that we are required to withhold employee taxes for federal, state, and the employee portion of Social Security and Medicare. Going back a couple slides here, this is the employer portion that is paid, but we also have to forward the employee portion as well and withhold and then subsequently pay that when it comes due. We recognize unearned revenue. We've talked about this earlier, but a liability for unearned revenue arises when a customer pays in advance. So our example was, a football game where we pay for the tickets in advance and then and recognize a liability and then wait to recognize it as the services are rendered. So you can see that there. The one thing to be careful about is most of these current liabilities have the word liability or payable. Well, unearned revenue looks because it says revenue, it looks like it's an income statement item, but it is not. It is a current liability. Okay, we note that most liabilities are expected to be repaid with cash, but we might be also able to just provide services or deliver goods rather than making cash payment. So we recognize that possibility. Maturing obligations to be refinanced. One special type of long-term liability is an obligation that will mature in the current period, but it is expected to be refinanced on a long-term basis. So there might be a big loan that is due, and we are going to we either don't have the cash or we decide to take another loan, maybe at a lower, hopefully, interest rate. And if our intention is to refinance it, then we can at the management's, if they express the intent and ability to refinance, then it can continue to be classified as a long-term liability. These long-term liabilities involve long-term liabilities. Usually there's not many of them, so not a lot of transactions, but they're usually for large dollar amounts. So you're going to get a large loan and take care of it once or a few times. Whereas current liabilities happen frequently. Lots of operating transactions with suppliers, maybe thousands of suppliers that affect payables. And so we just recognize that difference. So it is typical in Japan for short-term debt to have lower interest rates than long-term debt. As a result, Japanese managers find short-term debt more attractive. And so you can just see some international differences that might come. The outcome is that short-term debt in Japan works much like long-term debt elsewhere. They're just going to continue to refinance and renew. And so that's a difference between countries. Allocating installment payments between interest and payable. Okay, so as we pay our installment payments, this is where we're making payments a little bit at a time consistently. I like to think of this as a mortgage, but a mortgage, some of it goes to principal to pay down the loan, some of it goes toward interest. And so we just have to carefully consider that. And so we want to identify the unpaid principal balance. Number 2 here, we want to recognize interest expense as whatever the unpaid principal still is and what the interest rate is for that month. And then anything over the interest expense is going to go toward principal, and we're going to compute a new unpaid principal balance. So the example here is King's Inn purchases furnishings for $16,398. It's to be paid as an 18-month loan with payments of $1,000 and an interest rate of 12%. And so we're going to look and create an amortization schedule. And so you can see what it looks like here. Okay, so we have $16,398. We make a $1,000 payment. And so we're going to recognize, hey, what is the interest expense on that? And so we're going to take that amount. So we're essentially paying interest of 1% per month, right? And so if it's 12% for a year, 1%. So 1% of 16,398 rounded is 164. And so 164 is paid for interest. We have 836 left of the $1,000, so that reduces the unpaid balance. Okay, and then we run it again. Well, the next month, from November 15th to December 15th, another 1%. So 1% of this is 156, and it just continues until the loan is ultimately paid off. And so you can see what that looks like. All right, so here is the next, and here we work all the way down until it goes, till it's finally completely paid. And so this allocates money between interest expense and a reduction in the unpaid balance. So we can see what that looks like. So for the first payment, the journal entry would be debit interest expense for 164, debit note payable, which the installment note payable will reduce that amount, and we're going to give up or a credit of $1,000 for cash because that's what we had to pay. So this is the journal entry. We make a similar one each month as we go. And so this just kind of works through the period. So this just represents what would be the adjusting journal entry at the end. And so here we recognize, so remember from the first one from December 15th till January 15th, we have half a month. And so we need to reflect that half a month here. So the balance was 14,718, 1% monthly, but it was just a half a month. So we need to recognize an accrual of $74 in interest payable. Okay, so let's talk for a minute about bonds payable. If it's a big project, such as we're developing an oil field or purchasing a controlling interest in another company, we may need to raise a large amount of money, perhaps 50, 100, 500 million, even $1 billion. And so we may need to sell additional shares of capital stock to raise that money or issue bonds payable. When bonds are issued, we're going to issue them to bondholders, but the corporation usually utilizes an investment banking firm. They're called an underwriter, and that makes sure the underwriter assures the corporation that the entire bond issue will be sold without delay and that the entire proceeds will be available at a specific date. So they're our helper, and they help make sure it happens. And so bonds are sold in an organized securities exchange, and they are quoted as a percentage of the face amount. Okay. So there's a number of different types of bonds. There are mortgage bonds, which means they're secured by the pledge of assets. So let's say I buy some huge equipment and I say, hey, if I don't ever pay back this, you can have the equipment. Or it's the same thing for a mortgage loan. If I can't keep up with my loan, well, it is secured by my house. And so if I don't make payments, then they can sell my house to pay it back. A debenture is an example of an unsecured one that is not secured by a specific asset. Callable bond means a corporation has the right to redeem the bonds in advance by paying a specified call price. Why would they ever want to do that? Perhaps interest rates have fallen. A convertible bond may be exchanged at the option of the bondholder for a specified number of shares, so it's convertible from a bond into shares of capital stock. A junk bond is a bond issue that involves substantial risk, and that means the interest rate will be really high. So you can kind of see those differences. So we're learning the different types of bonds. An important advantage of raising money by issuing bonds instead of stock is that interest payments are tax deductible, whereas dividends to stockholders are not deductible. And so that's an advantage there, and a reason that we might go with that instead of issuing equity. So as an example, a corporation pays income taxes at 30%. If this corporation issues $10 million of 6% bonds payable, it will incur interest expense of $600,000 per year. That's just 6% times 10 million. This interest expense, however, will reduce taxable income by $600,000, reducing the corporation's annual income taxes by $180,000. That's the $600,000 times the 30%. Okay. And so that means we can pay $180,000 less in tax. As a result, the after-tax cost of borrowing the $10 million is actually the net of $600 less $180, or $420,000. So essentially, we're paying 4.2% is the true cost rather than the 6%. And so we can do that typically by using 600,000, that's the interest, and times 1 minus, and I call that 1 minus T, 1 minus the tax rate of 30%. So you can see what that cost might be. So the accountable events when we'd want to do a journal entry is when the bonds are issued, when interest is paid periodically, if we need to recognize an accrual of interest payable at the end, recognizing interest expenses owed but cash has not yet been paid, and then finally end when we retire the bonds at maturity. And so here would be the example for Wells Corporation issuing $1 million of 6%, 20 years bonds payable. Okay, so this would be the initial issuance. Here would be the semi-annual payment. So we pay $30,000. So that's 3%, right? So that's just the first 6 months. So half of 6 is 3%. 3% of $1 million is 30,000. So we recognize that. And we also need to recognize, hey, at December 31st, we haven't paid the latest amount. We owe 4 months worth of interest. So take the $1 million, multiply by 6%, and then multiply by 4 months for the 12 months, 4 twelfths, for $20,000. And then when it's ultimately paid, we'll take that off. It's going to be paid on March 1st. We owe another 2 months of interest. That's January and February. And we have bond interest payable that we accrued at the end of last year. Now we're going to pay that off with our $30,000 interest payment on March 1st. So you can see kind of how that goes. Bonds are often issued between specified dates. The investor pays the interest accrued up to the date of issuance. So even though the bond might be start with the date of March 1st, it might not be sold until, March 15th. And so we've just got to take care of that difference in time and make sure that's correctly reflected. So bonds might be issued at a discount or premium. The amount that corporations actually receive from the sale is the present value of the principal and interest payments that they will pay in the future. Okay, so it's the present value of those. Underwriters usually purchase bonds from the issuing corporation at a discount. That is at a price below face value. When bonds are issued, the borrower records a liability equal to the amount received. So if it's at a discount, then the liability is smaller than the face amount of the bond issue. However, at the maturity date, the issuing corporation must repay the full face value of the bonds. Okay, so I would take these steps slowly and see how this works. So even though the principal is $1 million, and we're going to owe that $1 million in 20 years, the full $1 million, but we got $970,000. The stated interest rate is 6%. The interest rates are 9.1 and 3 run. So if it's issued at a discount, this is going to be the journal entry. We owe bonds payable $1 million. We got $970,000, and we have a debit on discount on bonds payable. Okay, so we can see what that looks like. And as it's shown on the balance sheet, the long-term liability is going to show up as $970,000. Okay, so the discount on bonds payable is a contra account. And so it reduces the amount or the net carrying value of the bonds payable. So that's what's going to be shown on the balance sheet. We make our semi-annual payments. Okay, so we pay $30,000 and we amortize the bond discount. And so it's going to be the $30,000 discount divided by 20 years. That's 1,500 times half a year would be 750. So the semi-annual interest expense is different than the interest payment. It's going to be $3,750. And you can see that the bond discount is reduced by $750 every 6 months. And so you can see how that goes. So if we have 4 months of accrued interest, we have $1 million. We've got 6% interest. 4 months have passed. So we're going to recognize that $20,000. And we're also going to work and reflect 4 months worth of the amortization of the bond discount for $500. And so you can see what the journal entry looks like there. So this represents 4 months worth because we've got to accrue interest from September 1st through December 31st to make sure that's appropriately accrued. And so we can see what that adjusting journal entry will look like there. All right, now it's 2 months later. We need to reflect 2 months of interest, the amortization of that discount now for 2 of the months. And so now when it comes time to finally pay, we've got a fairly, interesting journal entry, right? And so bond interest expense, $10,250. There it is. Bond interest payable, $20,000. And that was from here. Here's my bond interest payable. That's the accrual from the end of the month. We pay cash of $30,000 and recognize the discount on bonds payable for $250. And that's for the last 2 months here. So that is reflected there. Now, bonds might also be issued at a premium. Okay, so they might be sold to the underwriter. This says 103%. They're at a price of 103. That's 103%. 1.03 times $1 million would be $1,030,000. And so we can see that reflected here. Similar dates as the last example, but now instead of a discount, we have a premium. So I just want to go back a few slides. Notice this premium is kind of an add. And if you go back a few slides here, you're going to see this as a contra. So it's going to be a debit, but the premium here is a credit. So we can see what that looks like. So we're going to amortize this premium over 20 years. So it's just going to go the other way. And so here's the premium. The carrying value is going to be $1,030,000. And now we're going to work through, and we won't go through this in detail, but I encourage you to go through these slides and see what it looks like. But you can kind of see what we're working through here, and that it actually reduces the amount of the interest payment each period. All right, from a conceptual point of view, investors might pay a premium to purchase bonds that pay an above market rate of interest. So if you're paying more than the interest rate, it's going to be a premium. If the bond pays below the market rate, then investors will buy them at a discount. But these concepts seldom come into play when bonds are first issued. Most bonds are issued at the market rate of interest. So that helps us understand how this might occur. Now, you may have learned about this in another class, but the present value of a future cash receipt is the amount that a knowledgeable investor will pay today for the right to receive that future payment. The exact amount of the present value depends on, I always say, the amount's timing and rate or uncertainty. The amount, how much are you going to get? What's the length of time until the payment will be received? So how much, when, and then what rate of return is required given the risk or the market. Okay, so the rate of interest that will cause a given present value to grow to a given future amount is called the discount rate or effective rate. The effective interest rate required by investors at any time is going to be the going market rate of interest. And so we'll see what that looks like here. So, okay, so IBM sold to underwriters $500 million of 9 3/8% 25-year debenture bonds. Debenture means there's not a secured asset. The underwriters plan to sell the bonds to the public of 99 5/8. Just as the bonds were offered for sale, there's a change in the Federal Reserve policy, and there's an upsurge in interest rates. Within 1 week, the market price for the bonds had fallen to 94.5. The underwriters dumped their unsold inventory at this price and sustained one of the largest underwriting losses in Wall Street history. So you can see the difference. So it's a big amount, 500 million. You can see the big change there. But during the months that followed, interest rates soared to record levels. Within 5 months, the price of the bonds had fallen to 76 3/8. As a result, nearly 1/4, that's starting at 100 and going to 76 3/8, had evaporated in less than a year. At this time, the financial strength of IBM was never in question. This dramatic loss in market value was caused entirely by rising interest rates. And so you can see the huge impact that would have. Now, we want to talk a little bit more about estimated liabilities. The term estimated liability refers to liabilities that appear in financial statements at estimated dollar amounts. So lots of estimates. There's quite a bit of uncertainty. Okay, but we recognize, or a liability must be recognized and becomes part of the company's financial statements. Recognized means a journal entry will need to occur. And this happens when the liability is known to exist, and the uncertainty as to the dollar amount is not so great as to prevent the company from making a reasonable estimate. Okay, so it exists, and there's an ability to make a reasonable estimate. Okay, and that will allow us to book a journal entry. So one of those examples of an estimated liability is a loss contingency. A loss contingency is a possible loss stemming from past events that is expected to be resolved in the future. Loss contingencies differ from estimated liabilities in 2 ways. Well, the loss contingency has a greater degree of uncertainty. So if we went back to the estimate, it says, hey, okay, reasonable estimate. Usually, typically, we can estimate how much that is based on past experience. But a loss contingency may not be able to. Often the uncertainty is to whether any loss or expense has been incurred. In contrast, the loss or expense related to the estimated liability is known to exist. The concept of loss contingency extends not only to possible liabilities, but also possible impairments of assets. Okay, so a common example is a lawsuit. Lawsuit is based on past events, but until the suit is resolved, uncertainty exists as to whether the company has sustained a loss, and if it has, how much was that loss. So you might have been sued. You may lose, you may not lose. What's the probability you're going to lose? So does a liability exist at all? And if so, how much is that loss? So loss contingencies are recorded in the accounting records only when both of the following criteria are met. It is probable that a loss has been incurred. Okay. So probable we're going to lose the lawsuit. And the amount of the loss can be reasonably estimated. So it's probable and reasonably estimable. When these criteria are not met, loss contingency are not recorded in the financial statements, but are disclosed. And so that's the difference. So let's go back to our estimated liability. If it's an estimate, we know it to exist. Well, that's not the case for loss contingency. We don't know if we're going to lose or not. And talking about the uncertainty, can we make a reasonable estimate? So again, is it probable? Is it reasonably estimable? And that's the question associated with the lawsuit. So for a company in October 2028, the company was named as a defendant in a $250 million patent infringement lawsuit. Company denies all charges and is preparing its defense. It is not possible at this time to determine the ultimate legal or financial responsibility that may arise as a result of this litigation. So what are we noting here? We're saying there might be a chance of a loss, but we just simply not possible to estimate if there is a loss and how much it is. And so we are simply disclosing that. So in this case, it is not probable and definitely not reasonably estimable. And so if both of these criteria are not met, then we need to disclose in the financial statements. And here in our footnotes is what we're disclosing. All right, contracts for future transactions are called commitments. They are not liabilities, but if material, they are disclosed in notes to the financial statements. Okay, examples of commitments. A corporation's long-term employment contract with a key customer, a contract for construction of a new plant, a contract to buy or sell inventory at future dates. So let's give an example here. I have signed a contract to build a new plant. Okay, but the plant hasn't started. It's not there yet. And so we can disclose this, but the contract's been signed and we are committed, but we haven't had any liabilities yet. And so these are only going to report it if they're big enough, if they're material. And so that's kind of the level. But again, this is not a liability. This is just needs to be disclosed. Okay. So we have a number of ratios, measures, indicators that we can use to evaluate the safety of creditors' claims. So creditors are going to be really interested in, hey, are you liquid? We're going to use a quick ratio. Okay, are the current assets bigger than the current liabilities, both in terms of working capital and a current ratio, and a number of other ratios that might be considered to see, are they going to be able to pay, the loans as they come due and any other liabilities as they come due. All right. So noting here, evaluating the safety of creditors' claims. Hey, we want to know, is there enough income to cover the interest? And if so, how many times? We call that the interest coverage ratio. We would expect this to be greater than 1. The higher the ratio, the better. And so that's one ratio that's run. Okay. How much debt should a business have? Okay. Is it wise for a company to use long-term debt to finance growth? You can't, there's a limit. There's only so much you can do. And so you want to just ask this question. For example, is the return you're getting on assets greater than the interest rates being paid? So if you're not getting a greater return on your own investment and looking at a company, if it's not greater than interest rates being paid, if it is greater, then you're going to increase. You're going to get more net income and a higher return on equity. Okay, but if not, it's going to decrease it. And so you're going to want to see that. And that's just a measure of what it will do when you lever your company. And so we have some examples here I encourage you to work through and thinking ethically. So the Financial Accounting Standards Board establishes accounting standards. It's a detailed compilation of accounting standards on a subject-by-subject basis. Okay, so one is, a topic today is environmental obligations. And simply saying, what is our ethical and social responsibility to take care of the environment, to prevent pollution? Are we a potentially responsible party? What's the cost associated with remediation? And as we recognize these environmental obligations, we recognize our social responsibility to take care of these issues. And as we talk through these, we look and say, many loss contingencies are a single past event. Okay, a lawsuit, right? Something occurred, there was an event. But environmental remediation might be something that's happened for a long period of time. The existence of a liability for environmental remediation becomes apparent and the amount of liability becomes estimable. And at that point, we need to record the liability because a loss is probable and it's reasonably estimable. And so we need to recognize that commitment. I think the ethical part of this is these are very unique circumstances and require a lot of professional judgment. And so we need to work with others to gather this information and determine if a liability exists, and if so, what the estimated dollar amount would be. And that's one of the ethical responsibilities. We recognize that there are other types of liabilities. Leases, post-retirement benefits, deferred taxes. These are special type of liabilities, especially in bigger companies, that have to be recognized and really a subject for a more advanced course. And that completes our discussion for this chapter of liabilities.